This is Turkey, the 17th largest economy in the world. A country and an economy which is no stranger to controversy. Yet, its ongoing currency troubles with the Turkish lira are arguably its greatest macroeconomic headache at the moment. But why? Why has the Turkish lira plummeted by half versus the dollar since 2018? Ultimately, this is due to Turkey's vulnerability to capital inflows, the perils of high inflation, and out-of-step interest rates. Though to truly unravel this complexity, I need to tell you a story which involves the credit crunch, cheap credit, and an everyday economic instrument that the President of Turkey has called the mother and father of all evil. So in order to tell this story, we'll be addressing when Turkey's problems first started to appear, what Turkey's main macroeconomic problems actually are, how Turkey has tried to solve its lira crisis, and why initial plans didn't work out. So if this sounds like the type of content that you enjoy watching, please consider hitting that subscribe button and notification bell. So when did Turkey's problems first start to appear? In the aftermath of Turkey's 2001 financial crisis and IMF bailout, which was ironically due in part to high inflation and foreign capital outflows, the economic good times rolled in. But, and there is a big but here, these good times sowed the seeds for where Turkey finds itself today. Between 2002 and 2007, the economy grew rapidly at an annual rate of 7.2%. Following a short recession in 2009, it bounced back strongly in 2010 and 11 with growth over 8% a year. Such stellar growth made Turkey one of the fastest growing economies in the G20. However, as time went on, this rapid growth became more unbalanced, being driven mainly by fast capital accumulation. This capital accumulation was based on rapid foreign capital inflows of so-called hot money, which was used to largely finance construction activities, which is highlighted by an interesting little fact that Istanbul now possesses the second highest number of skyscrapers in Europe, after Moscow. The majority of the capital accumulation was financed through foreign debt, as the country had access to cheap credit in a world of low interest rates, a global economic recovery at the time, and significant quantitative easing. However, when you build your economy on the sand, at some point or another, it will come crashing down. For Turkey, this crash came about in 2018, when rising inflation, concerns about an overextended banking system, and the independence of the central bank all coincided. You see, in most advanced economies, the independence of the central bank from the government enables it to set interest rates and implement macroeconomic policies which protect the economy. Unfortunately, in Turkey's case, the government passed laws giving it a say over elected positions and put the central bank under pressure to drop interest rates and expand credit. In doing this, it was effectively planning for Turkey to borrow its way out of the crisis, and this is a big part of its current problems. The point about interest rates can't be emphasized enough. Contrary to conventional economics, President Erdogan referred to interest rates as the mother and father of all evil, arguing lower interest rates would see them through the economic turmoil, an unconventional economic approach which goes against the widely held view that low interest rates are an expansionary policy which tends to lead to higher inflation, not to mention a weaker currency. Now, this all helps set the backdrop to Turkey's current crisis, an economy which slid into recession in 2018, a currency which has fallen by 60%, and an inflation rate in the double digits. So given these events and factors, what are Turkey's main economic problems? If we were to point to one thing, it would be Turkey's high inflation rate. You see, inflation is like Father Time, slowly, or quickly in Turkey's case, eroding the value of money. At the beginning of the video, I mentioned that Turkey has suffered from high inflation in the past. And to put it in context, the country's inflation rate is a lot better than it had been in the 90s, but has been above 15% since 2018. Typically, some inflation is expected, and a sign that an economy is moving, with most central banks targeting 2%, whereas Turkey has been targeting over 7% a year. From a currency perspective, the problem with inflation is that if it is more than the inflation of other currencies, it can diminish the value of the currency. This is because currencies are constantly seeking to balance out with one another, to find out how much one currency is worth than another. In Turkey's case, high inflation was an important factor in the lira's decreasing relative value compared to other currencies. Now, one way to counter higher inflation is to simply offer higher interest rates on Turkish lira holdings. Yet as explained, Turkey has not been a fan of higher rates, dropping them from 24% to 8.25%, a trend which was broken in September 2020 with a 2% rate hike. Though most economists believe this 2% increase didn't go far enough, as Turkey's real return, after offsetting any interest payments with inflation, is negative. Negative real returns are a huge problem for a country dependent on capital inflows or so-called hot money, which follows opportunities across the globe. Yet we can take inflation to be as much as a symptom as an underlying cause. The core issue for the lira is excessive supply relative to demand. Turkey consistently spends more on imports than exports, leading to a large current account deficit. Now you may be thinking, but so does the US or the euro, and they don't experience the same issues. Well, that's another story, partly to do with reserve currency status, which I explained in a previous video, the link to which should be appearing on your screen now, and in the description below. In Turkey's case, a big problem is that demand for the lira through Turkish exports is less than the supply of lira through paying for imports. A problem made a lot worse by the complete collapse of tourism in 2020. You see, tourism is a key economic sector for Turkey, and crucially a usually reliable source of foreign currency. About 45 million overseas tourists visited Turkey in 2019, equivalent to 60% of the population, and all those tourists brought with them a combined $35 billion. But that was in the good times, with arrivals in the first half of 2020 down by 3/4, a big shock to the system. Like any currency whose currency quickly loses value, this has forced households to swap their quickly diminishing liras for a more stable foreign currency, a trend known as dollarization. Why dollars? Well, because as the world's main reserve currency, it is considered a safe store of value. As such, Turkey's dollarization has been high, with the share of Turkish deposits held in foreign currencies reaching 50%. Whilst dollarization may help protect household savings, it can actually make a currency's decline worse, as more of the population sell more liras for less dollars. It also restricts the effectiveness of economic interventions, as there are less liras being held by Turkish households to be impacted by government policies. At this stage, things appear pretty bad, especially for households, though the country's financial companies are also facing challenges which are contributing to the crisis. Chief among them is looming repayment deadlines. If you remember earlier, I mentioned that during the good times, Turkish companies borrowed heavily externally. Well, yeah, this was largely done in dollars, and now an estimated $170 billion of debt is coming up for repayment. The trouble is that whilst the debt is in dollars, Turkish companies earn mainly in liras, so the size of the debt grows as the lira plummets relative to the dollar, a key risk to the financial system if the companies can't refinance their dollar-denominated debts. So after all of this, what has Turkey tried to do to resolve the issues? The central bank has been trying to meet a number of mutually exclusive goals: maintain low interest rates, reduce inflation, promote economic growth, and keep the lira stable. How it has tried to achieve this reveals the catch-22 Turkey finds itself in. Earlier in the video, I mentioned Turkey's central bank has lost some of its independence. This has been made evident in its low interest rates, done in an attempt to keep the economy moving through easy access to cheap credit. Credit which has fueled Turkey's stellar economic performance in the past. The problem is that low interest rates have been a significant factor in high inflation and the lira's devaluation. So to address this currency slide, the Turkish central bank has been propping up the value of the lira through buying it up on the open market. Whilst the lira is meant to be a free-floating currency, in a bid to maintain price stability, the Turkish central bank has spent a considerable portion of its foreign reserves buying liras on the open market. To boost its ability to do this, Turkey tripled a foreign currency swap deal with close ally Qatar to $15 billion. In addition to buying dollar reserves, the central bank has been hedging its bets by buying up the world's ultimate reserve currency, gold. In fact, Turkey has been doing this to such an extent that in July 2020, it became the world's largest buyer of gold, overtaking Russia. Why? Well, the jury is still out on this one, but commentators suggest it's to do with rising concerns over its ability to access dollars, with a direct dollar swap with the US on a similar basis to the Qatar deal being turned down by the US government in the recent past. The country also took the rather unconventional step of temporarily banning 6 large currency trading banks from trading the lira, in the hope of stopping speculation on its weakening currency, a move considered to be a step away from an open liberalised market. So why haven't these plans worked out for Turkey so far? Well, basically these plans are underpinned by the assumption that the lira's crisis will be over in the short term. As you can imagine, selling your foreign currency reserves to support a currency is only a viable option for as long as you have reserves to sell. Unfortunately for Turkey, it is quickly burning through these reserves. Goldman Sachs estimates that the central bank has spent $65 billion on supporting the currency this year alone, with gross foreign reserves having fallen to $93 billion. This may sound like a substantial amount, but over half of these reserves are borrowed, with the bank relying on an elaborate system which borrows from the foreign currency savings held by Turkish citizens in Turkey's bank vaults, a way to capitalise on the high dollarization rate we mentioned earlier. In fact, a deeper dive into the accounts suggests that the central bank's net reserves are in fact in deeply negative territory, raising concerns that the bank is robbing Peter to pay Paul, leaving some wondering how long this can go on for. Well, some analysts think this will go on for as long as there isn't a run on Turkey's banks by local savers wanting to withdraw their foreign holdings, so not a sustainable strategy. As alluded to earlier, the country's efforts have been significantly hampered by negative real returns, demonstrated through high inflation compared to low interest rates. These are keeping foreign capital, or hot money, out and investors away. Economists are in general agreement that Turkey will need to increase its rates substantially if it is to get the situation under control, something it has been reluctant to do, given its reliance on credit-linked growth and questions over the independence of its central bank. Nonetheless, the Turkish Central Bank's 2% September 2020 rate hike has been welcomed by analysts, but whether this is too little too late remains to be seen. So overall, we've seen Turkey's growth was largely funded by hot money inflows, which can leave an economy just as quickly as it enters. Growth was underpinned by borrowing on construction-related activities. The cracks really started to appear in 2018, when the related concepts of high inflation, low interest rates, looming foreign debt repayments, and negative real rates all combined to depreciate the lira. Turkey has followed an unconventional approach to address the crisis, not really addressing its low interest rates and propping up the lira through dwindling foreign reserves. This strategy assumes a quick recovery, as it only works for as long as foreign reserves hold out. Recent moves to raise interest rates are widely believed to be positive, but perhaps too little too late to prevent a full-blown currency crisis. As we come to the end of this video, we at Alt Simplified really hope that you've enjoyed it. We're interested to hear what you think about Turkey's currency crisis in the comments below. Do you think it's a result of inflation, an independent central bank, or something else? Let us know in the comments. And as always, if you've enjoyed this video, please do give it a like and consider hitting the subscribe button. See you in the next video.